The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years. COVID-19 still raging throughout the planet. And the stock market? It's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live, We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, live from Nashville. It's Thursday, August 11th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you're with us tonight. Hope it's cooler where you are than where it is here in Nashville. Is the bull market resuming with 2 exclamation points, or do we have question marks? Are we going back down again? It depends on who you listen to. You should be listening to me. And why do I say that? I'll show you in about 3 slides. If you are new to the program, you might not know the format, but here it is. We run through the monthly market review, world economy, employment scenario, all these topics to give you an idea of what's going on out there and why you can be encouraged that this is a great time to be in the market. Now, you might say, well, the first 6 months of this year were not so great, okay? But this isn't the first 6 months. We're now in month 8, okay? So hang with us and be prepared to be encouraged. That's why this program exists, to give you real news from a real portfolio manager about what's going on out there, not what the corporate media is telling you. If you're new to the program, please subscribe to us on YouTube. Hit the little bell so that you get updates whenever we put out a new video. Follow me on Twitter. I tweet every single day. The same post usually goes to Twitter, Facebook, and LinkedIn. Would encourage you to follow me there as well. In the monthly market review, sorry to have to crow again, guys. I called the market low on June 27th, which was still 10 days later than my great friend Tom Bowley and one of the best advisors, or at least market analyzers that I know in the world. I follow him very closely. We dialogue pretty much on a regular basis, but June 27th was the day. We're 6 weeks from that now. And as you could see yesterday, if you followed the market yesterday, I know we had a little profit taking today. That's not a concern, but a huge move yesterday when the market saw the CPI number was strong. And strong meaning it's lower than what the market thought it was going to be. So let's walk through that and let's see where the market is right now. First off, the NASDAQ, which is the strongest of the 3 markets that we track, the NASDAQ, the Dow, and the S&P. We also track the Russell, but certainly those big 3. The NASDAQ has now risen 20% from the June low. What does that mean? It means the NASDAQ's in a bull market. So if the market is here and it drops 20%, tradition, there's no official formula, says that we have entered a bear market. The market goes all the way down to the bottom, which in this case is June 17th. It rises 20%. Technically, it's back in a bull market. Now, you might say, well, that doesn't mean we're back at lifetime highs. Well, no, we're not. But we have risen 20% from the bottom, which generally brings money back into the market from investors that got out because they were scared. So we had that happen yesterday. We're still waiting for that in the S&P and the Dow. I'll get to that in a little bit. Some people will come to me and say, well, the trading volume is not real high, and that is true. So August is the lowest trading volume month during any calendar year from 1991 to the present. So we've got 30 plus years of data here. And you can imagine why it's low, and that's because people are on vacation. Okay, investors just literally money managers, investors, hedge fund managers just take the month off and go to wherever their fancy home is, and there's just less trading going on. But nonetheless, I still look at this chart, and I bring this to you almost every other show. This is looking back 100 years. This is created by my friend Tom Bowley. And if you look at this carefully, you will see 3 big red rectangles here. And the reason those are red is because those were secular bear markets. How many in 100 years? 33. That's an average of one every 33 years. So that's why when the pundits that are on TV and even in the newspaper are telling you, oh, we're entering a deep, dark, it's going to be, recession 4.0 or depression 2.0, the odds simply don't favor that. Now, I want you to lean in real carefully. I'm going to do it with you. And if you see that little downturn at the very top of the chart, that's what happened in January of 2022, the year in which we currently are. That's all that happened. I'm going to zoom in on this in a few slides, not right yet, but remember this, okay? The market moves up more than it moves down, and we are resuming the secular bull market that began April 10th, 2013, and I'm going to give you the reason why I believe this is the case. First of all, in January of this year, what were the leading sectors in the S&P 500? And the reason they're in red is because these are not sectors you want to be leading market performance. XLP is consumer staples. That's your Procter & Gamble's and various companies that, Hershey's, Cocoa, whatever, that are staples that you need. All right, Clorox. All right, real estate, utilities, those are not the ones you want to lead. And when this happened, it became evident, although it's impossible to time it exactly, that the market was rotating. The big players on Wall Street were rotating their investments from risky sectors into conservative sectors. All right, and that's what happened, and that's took a long time to play itself out. But what happened in June? The biggest performers in June, XLY, the consumer discretionary sector, the technology sector, industrial. These are leading what we call risk-on sectors. They are leading the market and still are since that June 17th low. So Wall Street decided enough was enough. They saw enough panic. There were no more sellers. The sellers were what we call exhausted. And so they entered the market and sold off their conservative, I'm going backwards, their conservative sectors and bought the more aggressive sectors. And again, if you've been watching this program for any length of time, we're not trying to be Lewis and Clark here. We're trying to follow the biggest money on Wall Street and coattail them. It's not always, they don't broadcast what they're doing. But that's how to make things work because they have the billions and billions, and in some cases trillions of dollars to move the market. So sector rotation back into these aggressive sectors, the ones I just showed you in green, are critical to this notion that I have that the 9-year secular bull market that began April 10th, 2013 is resuming. The cyclical bear market has ended. I called that on the 27th. 10 days, I needed another 10 days. Tom Bowley, to his credit, called it on the 17th of June. Now you're seeing, Bloomberg putting on the screen, wow, looks like the NASDAQ's finally exited the bear market. Okay, well, 6 weeks ago, and we invested you accordingly, and I hope you're seeing the results, those of you that are clients in your portfolios. These key aggressive sectors are XLK, which is technology, XLC, which is communication, and XLY, which is consumer discretionary. I have to say that XLC is definitely bringing up the rear, and that's because Meta and Facebook and Google and other huge mega companies are a little slow out of the gate to find the buyers interested in them as this market is pulling out of this cyclical bear market. So I know there's a lot on the screen here, but just look at the green area. This is an area of what we call resistance. And you'll see that the price on the bottom, the little lines that are moving there is actual price. All right, this is the S&P 500, and it's running into some resistance. Well, the S&P 500 is not the real leader. Let me show you the same exact time frame with the NASDAQ. Okay, and you can see those, lean in if you need to, but you can see the bars that have moved above this resistance level, and that's why the NASDAQ, as it almost always does, is leading us out of this cyclical bear market. And I've shown you in last month's program the sentiment indicators, which is discretionary outperforming staples. I showed you that here in a different way tonight. But when you see these, you can kind of get a clue of what Wall Street is doing. And again, we want to do what Wall Street is doing because they have the billions and sometimes trillions of dollars to make the market go the way they want it to. All right. Nobody ever met a poor Wall Street investment banker. Okay. So why has this year felt so bad? All right. Volatility is the answer for that. So if you're saying, well, okay, this feels worse than at any time since 2008. Okay, there's a reason for that. What are the 2 years that you see circled there? 2008 and 2022. If you look at the scale on the left-hand side, that's the number of days, okay, or the number of moves, pardon me, that, the number of days that are extreme, okay, in a given market period. This was 6 months. It was more in 2008, but still 6 months felt like a long time. And I'll show you in a couple slides comparing this particular bear market to the one that happened just 2 years ago. All right, look at the years on the right, and you'll see that the number of new highs, new lows, etc., it's just not as dramatic as those 2 years that are way off there. And, the number of days with moves exceeding the average range of the S&P. That is why this has felt so stomach churning this time. We didn't even have time for this in 2020, what we'll call the pandemic recession. Okay. Now, several slides back, I asked you to lean in. So now I'm actually showing you, rather than 100 years, I'm just showing you since 2009. So you see the blue arrows. That's where price is beginning this secular bull market, and it will come down to test what we call the midline. So halfway down, it will test this. Now, the only time it fully tested the very bottom of the range, you can see the line that's touching after the fourth blue arrow, was during the pandemic recession. It went all the way down there. But this particular recession only came down to the midpoint, and it's bounced right off of it. It just took a long time to do it versus 2 years ago. All right. And that makes a big difference emotionally. You can look at this chart, and we'll be looking at this years from now and go, yeah, you remember this little pullback? And everybody will go, yeah. But when you're actually living it, it's a very different emotional effect. But this is all that has happened. What is the trajectory of this chart, folks? The trajectory is a solid up move of a secular bull market. And this is the one that I'm talking about that we're currently in. Okay? Now, what happens in cyclical bear markets? I've shown you this slide before, but I didn't spend that much time on it. I have less slides tonight, so I can spend more time on them. Let's just look at 1957. Okay, so we had a cyclical bear market. I remember that. I was 3. My parents used newspaper for my diapers because it was tough times. All right, the 21 or 20.6, we'll call it 21% downturn. All right, but what's the takeaway from this? What happens when that cyclical bear market finally ends? 6 months later, look at the number, 9.8. 1 year later, 31%. 5 years later, 41%. 10 years later, 144% higher. This is the data. We can go to 1961. Just scan your eyes down there. You'll see the last one, of course, is blank because we don't know what that's going to be. But I want to go one up from now and see where the last bear market and recovery started. You see February 19th, that's 2/19/20, pardon me, and it ended on March 23rd. That was a cyclical bear market. The downturn was 35%. Now, why am I emphasizing that? Think back to what happened in that 2-month period. See how much worse that literally was a 50% worse pullback in the market, 35% versus 24.5%. But which one felt worse? Well, I can tell you this year felt worse. Why? Because of the length. It's all about the length, not even the depth. But if we look back to 2020, 6 months later, the market was up 47.6%. It's the last number in the green column on the left there. 1 year later, 78%. And there is no 5 years later. That's why it says minus 100%, because there's no data for that yet. We haven't been 5 years. I want you to focus on this. This is the history of the market in most of our lifetimes. Okay. Some of you may be older or younger and don't remember a lot of these. But as I said, I was there at 3 years old when the first one here happened. So We made it through all of them, and we made it through very strong, okay? This is a history going back even further of these bear markets. You see the decline, you see what the events were. There's usually an event that causes it. Panic of 1907, Trust Act, World War I, 1929 crash. Took a long time to get out of that. And that's because we didn't have good leadership in the White House, nor Congress, and the Federal Reserve was not powerful at all. That Federal Reserve wasn't even around in 1911. So these are the reasons why bear markets happen. There's always a catalyst. But you can see, and I'm going backwards, we come out of that, all right, with really positive numbers. Look at those numbers in green. This is the data you have to focus on. Turn off the TV. I'm not doing a COVID section anymore because I'm moving past that. And I just bring these out every once in a while. I was talking about the V-shaped recovery. Look at the blue dotted line here. When we were in the beginnings of the COVID V-shaped bottom, that's what it looked like. Look at the trajectory that it's making since then. We are back well stronger than where we were when the recession of 2020 started. Look how long it took for 2008. So this is where we get back to, once again, one of my favorite words, recency bias. It feels so much worse this time, but that's because even though this is 50% less, I just said it, than the downturn in 2020, it's gone on for so long. Why did 2008 feel so miserable? 2008, really 2009. Okay, March of 2009, March 9th, 2009 was the low of that bear market. Because it went on so long. It's right here. And it just step by step recovered little bit by little bit. We've done amazingly well recovery-wise compared to what happened in 2008, 2009. So I just want to show you this graph again. This is another way to display what happens during a bear market. Anywhere from 35, 40, 50%. This downturn we had this year, not even close to that. It felt like it because it took so long to play out. Almost 6 months, okay? So if Tom and I are correct, what does this mean? Let's go back, and I want to show you this chart again. So if we extrapolate from the worst year recovery, all the recoveries were very positive. The worst year, the average year, and the best year, where could the S&P be? All right? 4713. Okay, we're not even close to that now. If the S&P rises 29.5 or 0.6%, which is the worst of the returns, which I just showed you. If it rises the average amount during all of those bear markets, that puts the S&P 500 on June 17th of 2023 at 5186. If it rises to where the best one-year return was, that puts it at 6489. Guys, we are going to be in great shape. And in my opinion, that's still not the end of the secular bull market. That's just normal market behavior. And I showed you in those slides why this is not fiction. This is real. This is history. This is what has happened. If you want to bet against that, you're probably going to lose. And betting against that would either be shorting the market or taking your cash and putting it under a mattress or putting it into a 1% CD, which would be, frankly, I think, a catastrophe for your financial future. The stock market always bottoms before the news turns positive. That's just the way it works, all right? Earnings. We are nearing the end of the earnings season. It usually happens about the second week of the second month of the quarter. So we're looking back at the second quarter. That's April, May, June. We're halfway through August, sort of. And the typical number is 77% that beat, anywhere from 73 to 77. We're at 78 in the S&P. Not bad. Not bad, considering that I think we're in a recession, and we certainly have been in a bear market. We're going to talk about the recession coming up here. All right, look at the sectors that are doing well. Energy, of course, no surprise there. Industrials, real estate, technology at 87, well outperforming the average mean of the S&P 500. There's no data that you're seeing on this screen And if these companies lie about it, they literally can have, the SEC come after them and, fine and, charge the accounting firms that are associated with these corporations with a felony. So I believe this data is accurate. But this data is strong data, certainly considering what kind of shape the economy is in right now, which is not great, but it's, I think, heading in a better direction. So I'm going to take a breath and see what kind of questions we have here. I'm going to get a sip of water. Had a viewer ask about my tooth. Yeah, it's back. Thank you. All right. Good evening, Debbie from South Florida, my hometown. Good evening, Nellie from Georgia. Hey, Hossein, how are you? Big Daddy DIY, YOLO, how are you, sir? Bear Stearns exception. Yeah, how about that? Good old Bear Stearns in 2008. 2008. Showing my age there with that 19. But long live Bear Stearns, huh? 2008, pretty cataclysmic. So any questions, guys? I'll try to watch the chat box over here and try to get you out a little early tonight because it is summertime and the living should be easy, right? World economy. So what we covered, obviously, was where we are now. This next section going forward looks at what I think is going to influence the data and the market for the next month until I see you on September 8th. Question here. When do you foresee it ever becoming an overall bear market? World War III. Well, so overall, I'm not sure what overall means. Bear markets are always the exception. If you just simply look at the data, the market goes up 64% of the time. So overall, there's really only two kinds of bear markets. There's a secular, which means multiple cycles. And I don't want to wind back to that chart, but you could see, for instance, in the 20s, we had a 30-year bear market. So that's multiple business cycles. And then there are cyclical bear markets. There are cyclical bull markets and secular bull markets. There are more secular bull markets than there are cyclical, and just the opposite for bear. So if overall means when could we have a secular bear market, which are the evil ones, I've said on this program many times, I'm looking in the mid 2030s. I think we have another 10 to 12 years in this cycle if we follow the example of what the previous three secular bull markets have done. So there you go. I do not think it's around the corner. There are a lot of things going on in this country, and I'll get to some of those, that could change my forecast, but that's what it is right now. So the Ukraine situation is kind of stalemated. The red is where Russia has control. It has not expanded really in a month. This is the July 17th map. The kind of news of the day here was that Ukraine finally was able to work out an agreement to export some of its wheat. They're the fifth largest wheat and soybean exporter in the world. And then the countries didn't want to buy it. It got on the boats and it wasn't unloaded because those countries were scared of Putin that if they bought it, he might launch a missile on them or something. This is amazing to me what a bully can do if you let him get away with it. So inflation, this is an old topic. The market is not concerned about inflation. The bond market, which is the most sensitive to inflation, is not concerned about inflation. You do see small business sentiment, inflation, the single most important problem, and that is because business has to make far-reaching decisions on hiring, the number of widgets that they're going to produce, factories that they're going to build. So it's normal to see businesses more pessimistic than you see individuals. So the consumer, perspective is that inflation looks like it's going to drop. See the lines there? This is the consumer sentiment reading. I find that good because consumers are 66% of spending of GDP in the U.S. This is a positive, okay? Monthly rise in consumer prices. Yes, it's the highest in 17 years. I get that. I understand, but it is coming down. I'm going to wind back. There's that drop. This is sentiment, and we're going to see that U.S. inflation is past the peak. That's why the market, this is Thursday night, of course, yesterday made that huge move at 7:30 and 10 seconds, because when the data came out, it stunned the people that have big bucks, and so they rushed into the S&P and NASDAQ futures. I mean, it was a skyrocketing event, and it pretty much stayed strong. As I said, there was some profit taking today, but we have definitely broken above that. Think back to the earlier slide. The NASDAQ is 20% off its low. This consumer price index was great yesterday. The PPI today, which is the producer price index, also was down. So it's ebbing. It doesn't mean that it's high, and it certainly is not zero, which is what the president told you. It's not zero, but it is pulling back, okay? And so that's important. So if the corporate media is going to walk away from inflation because they can see but the market's not concerned about it, all right, so what are they going to talk about now? Well, the Google searches here are highest for the word recession that they've ever been, or at least in the last 4 years, and I think probably earlier than that, because there wasn't not a whole lot of Google searching happening before, say, 6 to 8 years ago. All right, people do this because they get scared. They hear a newscaster saying, "Oh, I'm putting everything in cash. It's all going to be under a mattress." So they Google recession and see how that could affect them. I really dislike the people in the media that do this, because it's just not good. It's not good for the consumer, and it's not accurate. Okay. If we have a recession, this might be a first. They always say that history repeats itself, but sometimes it doesn't. This could be, at least in my lifetime, which is pretty long, but I don't know of any time before I was born, which is 1955, where we had a full employment recession. So look at the chart. This is what we call a dot plot, not referring to the Federal Reserve, but look at 2009. So the cyclical unemployment was exceeding 4%, okay? And the output loss, that's GDP, was also almost 4%. So 2009, really tough. It obviously picked up after that March 19th that I mentioned earlier. 1958, 1975, maybe you guys can think back and remember those years. These were bad times, okay? Because output dropped, and because unemployment rose. Those are the hallmarks of a recession. But look at the red dot. The estimate is that we're actually going to have positive employment, meaning we're still adding jobs as we head into a recession. It's never happened. Now, is it adding a ton of jobs? We don't know that yet. Okay, we still have unfilled open positions almost across every industry in America. And the GDP, although there is a negative reading for the second quarter, there's going to be 2 revisions. There's one this month and one in September. We'll see if that plays out, okay? You will still see the probability indicator that if it doesn't happen now, there's a 26%. That chart looks so dramatic, but it's still only 26%, okay, in 2023. Do I think that's possible? I think we're already in a recession, okay? Because the market is behaving that way. The consumer is behaving that way. And I'll show you when we get to real estate, people buying houses, which is the biggest consumer item, are behaving like they're scared. All right. So is it likely this year? I think we're in it. Is it likely by mid-23? Could be. Do I sit and think about it and rub my hands anxiously? I do not. Because we live through recessions. We always have, and we always will. People still buy things that they need and things that they want. I showed you the rotation earlier away from consumer staples and utilities into technology and consumer discretionary items. And that's not just you and I buying this in our little tiny portfolios, respectively, compared to Wall Street. These are the big players that are making those decisions for billion-dollar hedge funds and pension funds and endowment funds. Okay? The employment scenario, so whenever I do this program, it's the Thursday after we had employment. So the unemployment rate stayed the same. You can see the flat line there on the screen, and that's a positive. It's not going down, but it's not going up. If we're heading into a recession, it should be going up. We just talked about this, right? It's not, all right? Now, job openings did fall to a 9-month low, but the labor market's holding tight. There is still plenty of jobs available for people that want them. So a little bit of a dip, yes, but I'm not seeing this bar line down near the bottom, which is where it would be if we were heading into a recession, least typical. That's why I had the chart 3 charts ago saying, is it possible this could be a full employment recession? It's possible. Anything's possible. But it'll be the first time in my lifetime, probably in history. I showed you this earlier. This is a little different permeation of it. The great lockdown and recovery, we are back at 100% employment 24 months after that February 19th date, 2020, when COVID hit. Look at that slam down there. We just, 13.5% unemployment within weeks because they shut down the country. Okay? But look how quickly it's recovered compared to 2008. We should be celebrating as Americans that we pulled ourselves up by the bootstrap and went out and got a better job, and we contributed to this recovering economy, okay? Look at what happened in 2008. We're at 70 months to get back to where we were before that downturn. We've already equaled it in 24. That is great data. It's just great data, folks. Now, there's some people that have a job but aren't able to work due to childcare problems. And I'm especially sensitive to this because one of my children is a professional nanny placer. Maybe she's got a different name for it, but she places nannies in various cities and states and expanding because there's so much of a demand for this. But look at the spikes there, and it's because people can't find childcare. All right. Once this supply problem has alleviated itself, that's even more people coming back into the market. And I think that's a positive. The trend is not going to go higher here. I don't see that happening. The trend is going to go lower as far as people, once they finally find, proper child care. It's going to help the employment rolls and push against this tendency for us to think we're going into a recession, because more people will be working, all right? So the expectations for higher employment, you get this from consumer expectations. There's a lot of mixed data in this month's program because consumers see that inflation's coming down and yet they think there's going to be higher unemployment. That's because they didn't watch the slides I just showed you, all right? We have a great situation here where we probably are in a recession because of the 2 negative quarters, but we have unemployment at a constant 3.6%, which is among the lowest numbers we've had in decades. All right. So why are people quitting their jobs? Well, there are various reasons. They obviously don't add up to 100 because sometimes there's multiple reasons, but lack of career development, traditional, they want something different than just a traditional job. Inadequate compensation certainly is part of it. So what is the ultimate outcome of this? The ultimate outcome is people that have new employers are picking up 10%, 9.7%. I know of one specific case where a certain individual did some job shopping, had 3 offers, and actually doubled his salary because the demand was there for his particular area of expertise. Folks, there is plenty of demand in the U.S. economy. Plenty of demand. If it's not there for your area of expertise, maybe you need to look at something else because there is strong demand. And this happened to be demand from one of the mega companies, but there are plenty of small and mid-sized businesses that are hiring if people have the right skill sets. A country is not behaving like it's in a recession or headed toward a deeper one. Okay, let me check the board here before I ramble on any further. When do I foresee ever becoming more? I handled that. And what example or criteria are you comparing to this cyclical bear market? Let me see if I can figure out what you're saying here. What example or criteria are you comparing to? So if I'm comparing between cyclical and secular, it's certainly the multiple business cycles versus just one individual business cycle. So I'm not sure that's what you mean. That's sad about Ukraine goods. I agree, it is. The incredible thing is, I don't know if you guys read this, But Ukraine and Russia sat down at the table. Obviously, it wasn't Putin and, you know, I forget the guy's name that's the head of Ukraine right now. Sorry. They didn't sit down, but their staff did. And they worked out this trade agreement, even though they're still bombing each other. Okay. But obviously the recipients of all this wheat and soybeans just wouldn't take it because of intimidation. And yes, it's horrible. It's horrible. Didn't get the initial GDP numbers, already outcoming 2 negative quarters. Okay, so Andre, the way GDP works, and this is for all of you now. So let's say January. When they release GDP in January, they're talking about the fourth quarter of 2021. And then they revise that number because there's a ton of components that go into that number. All right, they revise it in February, they revise it in March and call that the last GDP number. And then in April, they're going to look at the first reading, and they call it a reading, of GDP for the first quarter. Okay, so this is August, so that means we're on the second reading when this comes out. It's not out yet. All right, so we had a negative reading all 3 months for the first quarter. All right, we don't have all the data yet for the second quarter, but it's certainly the first reading was negative. All right, so that's how it happens. It's just every month, if you have 3, an initial reading, a revised number, and a final number, and that happens for 2 quarters, that's technically a recession. Okay. All right. First time for everything since, 2016. I'm with you on that. So, okay. So I have to be careful with this section because I don't want to upset people on either side of the political spectrum. I cover politics because politics lead to policy and policy affects our portfolio impact. And there are things that are concerning me right now, specifically how our enemies are perceiving us and the lack of strength. And that's why I have to cover that in this section. I'll be through it very quickly. If it upsets you, don't leave the show. Stay with me. But it's important that you know this, okay? For whatever reason, President Joe Biden stood up at the podium yesterday and said we had 0 inflation in July, which is just a bold-faced lie. Now, I understand that people slip, but he didn't correct it later. His press secretary didn't correct it. And the White House did not issue a statement to the press saying, no, we were wrong. It's really 8.5%. Okay? This is concerning because this looks like dysfunction and chaos at the highest levels of the government, and I assure you our enemies are watching this. And equally concerning is the fact that our president can't put his jacket on. I mean, if you guys have seen this clip on Twitter, it's really disheartening. Now, I'm not saying this to pick on Joe Biden. What I am saying is that this map is in play for a world conflict, a crisis. All right? Xi Jinping is seeing the weakness. And I'm not going to weigh in necessarily, well, I guess I am, on Nancy Pelosi's trip to Taiwan. It was pretty astounding. I actually kind of liked sticking it to China, to be honest with you. But it has raised the anger of China. And if the market perceives that this invasion could happen because we are weak and or disoriented, then that affects us as investors. So far, there has not been an issue. At least I haven't seen enough market reaction to be concerned about to tell you about it, but I'm watching it. And that's why I have this in this section. Obviously, the raid on Donald Trump's Mar-a-Lago was, it depends on what side of the political spectrum you're on. Some people were cheering it, some people were irate, but it has never happened. And to this date, we still don't have a definitive reason why. So this is what causes arrest Trump and Trump 2024 signs. I mean, there's no way to get around the fact that Donald Trump is running in 2024. And it brings anxiety to the markets. It clearly brought anxiety to Merrick Garland, which is why he okayed this raid. So that's really all I have to say at this point. You probably have very definitive opinions on whether this should have happened or shouldn't happen. As a portfolio manager, I'm just looking out for you in regards to, is this going to affect market volatility as we head into the midterm elections. It's not like this is December and we finish the midterm. This is all happening right in front of the midterm elections, and it's important that we recognize that. Okay, economic indicators. Yeah, it's just, I look at these. These are things that I'm looking at that, again, I think can affect us over the next month. So GDI, I hardly ever talk about this, but it's gross domestic activity. This is buying and selling. It's not necessarily, it's done at the producer level. So it's not really PPI. It's not really consumer prices, but it does contribute to GDP. And there is an unprecedented divergence right now in favor of GDI. GDP is negative. We just talked about that. So you might see a revision this month and again in September to the positive, okay, because of this GDI component. This is something I've never talked about on this show or actually in any of my speeches or anything, because it's a little known data piece, but it's from the U.S. Bureau of Economic Analysis, and it's interesting. I think that there is an undertow of positive economic activity that might be eluding its contribution into GDP. I realize that's real wordy, but it's just one more reason why, if this is going to be a recession, if you blink, you might miss it, okay? One of the things I do watch is student debt. This is an issue, of course, I have with the current administration. I think just waving a wand and relieving students of having to pay back debt for the people who have worked 2 jobs to pay off student loans. It certainly seems unfair, but the current balances are increasing on student loans for 55% of the outstanding loans. There are trillions of dollars held by Sallie Mae, okay, so that's the government entity that holds student loans. And if this continues in this direction, it is not good for the U.S. economy. University of Michigan consumer sentiment, a little bit of a bump up there. I think we're going to get another reading. Is it tomorrow or is it next Friday? I'm not sure. But consumer sentiment, again, you might say, well, this kind of contradicts what the consumers are saying earlier. Honestly, consumers are mixed up right now. And part of the reason is because they're listening to news instead of forming their own opinion by looking at facts. Wow. All right. But this is where we are with consumer sentiment. We need the consumer to be optimistic. That's what turns things around. That's what keeps us from heading into any kind of substantive recession, okay? The Fed, I tell you, Jay Powell is going to go down as one of the worst Fed chairmen we've ever had. The guy just holds up his finger and wets it and sees which way the wind is blowing. The market expects the Fed to cut fairly soon. The red line is what Fed futures are saying. So Fed futures, the futures market, without going into a ton of detail, these are traders that bet on the future direction of the Fed's aggressive hikes or cuts. All right. And Fed futures are dropping. They're expecting that the Fed is not going to be raising rates past September. They're actually going to drop. It is my opinion and my buddy Tom Bowley's opinion that that is the case, that the Fed did a bunch of saber rattling so that participants in the market knew that they would raise rates if they needed to. But when it gets down to it, I mean, we're seeing, in fact, I just saw this literally as I was in my green room getting ready here, but Bloomberg said, yeah, you know, for the first time, automobiles are depreciating. You know, that's kind of the old way they work. You know, you buy it and they depreciate. But again, I've got 2 sons who love cars, and they're saying, you know, Dad, these used cars, you buy a car and then you can sell it back and actually make money on it. Well, that's great. It's not so great for inflation. Okay, so we're seeing signs that there's a reversion. Let's try that again. A reversion to the mean with cars. And that's good. The Fed wants to see these kinds of things. When we get to the housing section, you'll see that in bigger numbers. So this is what the increase has been. 2022, almost like straight up, 75. It's going to be 75 probably in September. Previous Feds, you see how the stair stepping happened in 2004, 2006? The market likes that because if it's just a little bit at a time, you don't feel it as badly. It's not in the news as much. But the 75, 75, and then there was a period of weeks there where people were betting, including the market participants, that we were going to have 100 basis point increase. That's not going to happen. It's not going to happen. All right. You heard it here. But still, this cycle has seen a pretty steep move here, and that's why you see 2022 there. I don't think it's going to go up and touch the level at 2004, 2006. It's probably going to stop at 3% and then ease back down as organically inflation is pulling back. All right, the Atlanta Fed, everybody and their uncle's got a projection out there. They're saying, yeah, GDP is going to drop. I put this up here just so you can see. There are 12 Fed districts. They've all got their opinion. Maybe things are going to be worse in the South than they are going to be in the North. People mostly watch what's happening in New York, Philadelphia, and Cleveland as far as the Federal Reserve presidents and their opinions. But actually, stocks tend to do okay during periods of Fed hikes. Don't try to read all the numbers, but I can just tell you there's the first hike. Those are the dates in the far left column. Just look under the green, percentage return during the cycle. All but 3 of them are green, meaning they were positive returns. And only one of them, which is 1972, had a double digit. The other ones were, minus 3%, minus 1.8%, and everything else was positive during Fed tightening. So again, turn off the TV. If the Fed needs to tighten to reduce inflation, that's a good thing. They're behind the game. They did it too slowly. They used the word transitory too many times and for too long, but I think Jay's finally getting it worked out now. I hope so anyway. So housing, this is the number one consumer spending area. So we're seeing listings having price drops. Look at that spike there. This year, the blue and the gray line are from last year. There were no price drops. Okay, that's good if you're trying to sell your home. But for inflation, our home here in Nashville, if I'm being candid, you can see it on Zillow, has dropped $100,000 since the peak of what it was estimated to be. I'm okay with that. First of all, I'm not trying to sell it, and that's why. But I want to see this real estate craziness back off some. So 7% of listings having price drops is good. New home completions is slowing down here, okay, because the demand is slowing down. Why is that a good thing? Because it's easing inflation. Does it mean that people are going to stop buying homes? Of course not. I saw this on Bloomberg, though. They interviewed this person. Yeah, we think probably now you're going to go back to seeing homes on the market for 6 months before they sell. That is ridiculous. Just from the population increase alone, that's ridiculous. But it gets eyeballs. All right, and that's why we say it. So tight supply limits the downside risk to housing. We still have not enough supply, not enough people putting their homes on the market. So that arrow just goes straight down there, and it's going to keep the market firm until further notice, in my opinion. We are seeing competition dips to the lowest level in 2 years. So what does this mean? It means people are shopping, and they're not just saying, okay, no inspection, no approvals, no bank loans. I'll pay cash. The buyers are not desperate anymore. They have a little more headroom than they did 2 years ago. And again, that reduces the pressure on inflation. So we had this sent to me from one of our viewers who's been a faithful viewer. Thank you for sending it. You guys can send me stuff, and if I think it's important, I'll put it on the show, okay? He said to me, almost all the spam calls I get from people wanting to buy my house. This may not be happening to all homeowners, and it may only be happening because of my age. These people think I'm either near death or moving into assisted living. But I've never had these types of calls, so I did a little research today, and I am seeing that this is really becoming a problem. You're getting a text, hey, want to buy your house? Give me a call. And you call and, let me just get some information. So what's the address again? And what's your net worth? And, what's your bank account? This is just horrible. And the people are preying on often high expensive homes that are older people that may be moving into a nursing home or something. and they're gathering this data. So be really, really careful when you get these. Block them. You can usually type the word stop. And if that doesn't work, you can go into your phone app and actually block the numbers. And I have probably 500 numbers on my phone that are blocked. So be careful on that, okay? All right, getting another breath here. I think we're going to get out of here early tonight. All right. Anybody? A lot of data. I'm trying to keep you encouraged. All right, checking over on my messages here. Using your iPad, that's good. Good. Keith. Andre, I hope I answered your question. You guys are quiet tonight, huh? All right, well, that's the essence of where we are. So this is what we covered. There's a lot going on. And it's only going to get busier as we head into what is going to be dubbed, I guess, every 2 years, the most important election in our country's history. It gets old. You can only have that happen, every so often. So, yeah, thanks, Doc. It's good to know it was a scam. And I'm glad you're encouraged, Nellie. That's great. Certainly that's important to me to keep you guys encouraged by giving you the best, most current, accurate data about what is driving market performance. Okay. Next show, Thursday, September 8th. That'll be after Labor Day. Wow, we'll be into autumn. Hard to believe. Hope you'll be here for that. I always end my show with this quote from Timothy: "For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind." I really appreciate you guys being here with me tonight. From Debbie, I get 6 calls a day and 2 offers in the mail to buy my house or property. Well, that's because you have such a nice house. I've been there. Have blocked hundreds of numbers and it doesn't seem to work. And that's because they will just stay on the same exchange and find a different extension. They're very, very clever. They're a nuisance. And the FCC, Federal Communications Commission, needs to step in and get more aggressive. You got to speak to your congressperson and say, I'm tired of being abused by these. Nobody wants these robocallers, these texters. It's just awful. Okay. All right, guys, thanks for being here. We're going to be fine. We are pulling out of this cyclical bear market. I think we're going to be at market highs. We're not now. Okay. So if you look in your account and say, why is he so upbeat? Well, because you have to start somewhere, and we have. All right. And I think we're going to be at market highs in January. Okay. That's generally when more money comes pouring into the market, 401k plans, etc. The election will be over. Let's hope maybe there's an end to the Ukraine situation. And you're right. It is a hard time to sell your home because there's nowhere to go after. I suppose you could go live in a tent in San Francisco. Oh, Nancy Pelosi could probably help you with that. I'm sorry, I digress. But you're right, it is tough. So if you're moving into a convalescent home or retirement village or something like that, I suppose you can do that. But it is tough to move on from that. So guys, if you have any questions, you can always shoot me an email, cb3@cb3.com. And I hear you on that, Nellie. Don't answer if I don't know who the number is. Yeah, if it's not in my caller ID, I let them leave a message and then I call them back if I need to. Hossein, The Unavoidable War by Kevin Rudd. Guys, jot that down. Would like to recommend a new book called The Unavoidable War by Kevin Rudd. All right, Tom in Lake Geneva. Thanks, buddy, for being an encouragement. I'm trying. I'm really trying, guys. Stay upbeat. We got a lot of things to be grateful for. God has really blessed this country. And yes, Nellie, you could move into an RV. And in fact, we have a classmate who spends a good portion of her time in an RV and loves that life. So, guys, enjoy the waning weeks of summer. Please remember that at CB3 Financial Group, we don't just manage your assets. We become one of them. God bless you all. I'll see you next time.